Profits. I'm EJ Antoni. I like to play an economist on TV some of the time. More importantly, joined by the one, the only Anthony Esposito, trader extraordinaire, Wall Street legend, and founder and CEO of Ascalon 6 Capital. Anthony, how are you doing today? How was your week?
I'm doing well. Week's been good, a little crazy, but the week has been good. Heading into the turn now. It's Friday morning. We have the wash confirmation this morning. A lot going on, a lot on his plate as far as inflation and rates. 10-year up was as high as 4.66. Inflation numbers look like they're going to be hot and potentially getting hotter. So that confirmation is something that we're watching today. Also looking at energy and also looking at this market, which has been a complete gamma squeeze all the way up to all-time highs. So it's been busy. EJ, I'd like to start by going through, as we talk about the market at all-time highs and just ran through rates and energy. I want to go into energy a little bit and really dig in a little bit of a different way. We had the reserve numbers out this week from the DOE. Those numbers were actually surprising to me, and you had touched on it last week. But before we do that, I want to go into some statistics as far as what kind of a market we're in and what we're seeing. And it's not at all to say that we are about to see a massive correction in the stock market. That's not where I'm at. I do think we are due for that, but there are structural reasons why the market's done what it's done. But I just want to read off a few stats, if that's okay, on what this market is doing at all-time highs.
Yeah, please.
So we have margin debt at market peaks. We've never seen more margin debt on the books at the prime brokers than we're seeing right now. We have the 10 largest stocks in the S&P 500, equating to 41% of the market cap. That's actually 14% above the 2000 peak. And 35% of the entire market cap for the S&P 500 is just Mag 7. That's kind of skewed. We can admit that. I know technology driven and all rallies have a group that, and all bull markets have a group that lead, but this is massively skewed. Also, 50% of all investment that you make in the S&P 500, 50% goes to AI. So you have 500 names, but 50% of your dollars are going just to AI names. So again, very skewed. We have the Case-Shiller, which I talk about all the time, above 40. The last time it was above 40, and the only other time in history it was above 40 was 99 into 2000, into that market top. We have the market cap to GDP ratio at 228%. That is a glaring red signal. That's actually what they call the Buffett indicator. We are well above market extension, market tops. 29 trading days of the first 93, so this is a couple of days old, had the S&P move in the opposite direction of overall breadth. That's the highest on record for days. So we have the group moving, and we can see that just from the breadth numbers I just talked about. We have the S&P 500 moving to the upside, where we have breadth moving to the downside in the index. So we're not seeing, although everyone's talking about this broad-based rally, we're not seeing a broad-based rally. We're seeing a very narrow, very negative breadth rally. Semiconductor stocks are now 4% of the 8% gain the S&P has seen year to date. Let me say that again. Semiconductor stocks in price have accounted for 50% of the S&P 500's year to date gain.
Wow.
That's unprecedented. Leveraged ETFs. I love this one. Leveraged ETFs, assets under management are 180 billion. That is up from 75 billion just 12 months ago. Okay. And long ETFs are getting 3 times the capital that short ETFs are getting. So that might sound very bullish, and for now it is, right? So every time somebody puts $1 to work in a long 3 times levered ETF, and by the way, obviously those numbers are over doubling as far as the exposure there in the last 12 months. Every time you put $1 in, $2, $3 gets bought in exposure. Mm-hmm. That's great. The problem is when that money turns around and flips out, and it's something to be aware of, every time $1 gets sold, that's $3 being sold. So while it feeds the beast on the way up, it will crush it on the way down. And the same goes for this gamma trade, this delta trade, and these zero data expiration options. Every time everybody's buying these calls on the day of, which is really a bet, it's a gamble. You're putting the dealer in position where they need to hedge their short position, so that they need to, which is an options position, and they need to buy stock. So every time you're buying calls, you're forcing the dealer on the option side to buy. It's creating this squeeze up, this structural gamma squeeze up that will reverse as people start to buy puts. And we see it on these big drawdown days. People fly into puts, 0-day puts, and we see this nonstop selling. And we've seen it recently. It feels like it was, a decade ago at this point, as we've had this massive rally in the S&P, but it will work the other way. Just be aware of it. We have the 10-year hitting 466 as the high, the 3-month high recently, a couple of days ago. We're at 455 now. We have crude, essentially front month crude at par. So we're dancing around 100. Has not come in, even though there's been what seems like we're on the path to peace and a de-escalation in the Middle East. Straits of Hormuz is still essentially closed, if anyone's paying attention. And with that, we have the S&P at all-time highs. So there is definitely some concern on my part. I'm definitely, obviously, we talk about it, a top-down long-short fund here. We're in the future space, a very small basket of futures, and we're technically driven. So our signals are coming from momentum trend indicators, which we've built and we've tested and we've traded live at the fund and previous to the fund with success. I'm very confident in the model and the signals that we get, but I will say that with the headline risk and with the risk of these derivative squeezes and kind of skew in the market, it's making it a little more difficult to consistently see where we're headed based on what historically has been the model call. All these things said, there is reason to be concerned that we are really way ahead of ourselves here. Mm-hmm. I'm going to now flip to you and something you said last week and then data that came out, and that was on the reserves. You had mentioned that the oil that's being shipped from the U.S. was actually it's not new drilled and produced oil, it's actually reserve oil. So we had the DOE numbers out as of May 15th. We had crude inventories in the U.S., the strategic reserve, as of March 20th at about 260 million barrels. Okay. That drop through May 15th was down to 231 million barrels. That is like off a cliff on the chart. Just to give some perspective, from May of 25, we were at 254 to 260 in the past 12 months. Now that was, pretty tight. And then we dropped off a cliff on these oil being sent out. So the concern there is that have we officially lifted the floor for crude, meaning even if this straightens out in the next week or two, even if the straits open up in the next week or two, what kind of damage have we done to the market? Here's my questions to you, EJ. What kind of damage have we done to the energy markets as far as pricing, supply, demand destruction? What does that do to inflation expectations? And then, what should we expect moving forward?
Great questions. I mean, basically 2 weeks ago, we set a new record for how quickly we were taking oil out of the Strategic Petroleum Reserve, the SPR. And then last week, we beat that record too. So in 8 weeks now, most of which is, most of this has been just the last 3-4 weeks, but still in the last 8 weeks, we took out 10% of the reserve. I mean, this is an incredibly fast rate of drain. Again, these are weekly records that we've been setting here. And it's not even staying here. We're basically sending it all to Asia. Some of it's going other places, but almost all of it's going to Asia here. And obviously this is all being done to try to keep that ceiling, try to keep a lid on global oil prices. It's obviously not sustainable. And it's not just us doing it, right? Yeah. You have nations like Japan, they actually have a far larger reserve than we do for good reason. They got 95% of their oil from the Gulf. So when something like this happens, a situation like Iran shutting the strait, they need to be prepared. They are. But still, the clock is ticking, right? This, again, it's not sustainable, not something that can go on forever. Oil production is not something you can, it's not a light switch where you can shut it on and off. It's also not a dimmer switch where you can easily turn it up or down. Mm-hmm. So it's definitely going to take a long time to ramp up production, whether that's here in the U.S. or other places around the world. There are not a lot of countries like Russia where there's a ton of excess capacity, meaning they
Okay.
could, if they wanted to, start exporting a lot more oil. They have increased the amount of oil they're exporting, but because of the because of the nature of getting oil out of Siberia and how expensive that is, prices are going to have to go up quite a bit before Putin starts really ramping up production, because they just have too many wells that aren't profitable even at 100, 130, 150. Now, now we're talking. Um, so yeah, unfortunately, what we're looking at right now, this whole supply shock that is being countered by taking oil out of reserves, those reserves have to be replaced. And we've talked about this before, how once the supply shock ends, it's going to get replaced with a demand shock. You're going to have you're going to have that same supply coming out of the Gulf again, but now there's an increase in demand. It's not going to come all at once. We don't have to refill the reserve as quickly as we drained it. In fact, physically we can't, just because of the limitations of the oil infrastructure and how it works with pumping water down so that the oil rises, or taking that water out so that the oil falls and there's room for
Yeah.
more oil, etc. Again, we don't have to go like too deep into the technicals here, but the fact is you are going to have a sustained amount of higher demand once supply comes back online, and that means that you now have essentially that price floor that's going to prevent oil from going back down to like 60 a barrel. So you're looking at all of that. What's the inflation dynamic here? Oil affects the price of everything we do and everything we buy. This was one of the big reasons why Trump had so much success in his first year at bringing down headline inflation.
Yeah.
It was the fact that you were bringing down energy prices, and that helped put downward pressure on all other prices. And I don't want to repeat myself too much here, because I know we've talked about a lot of this, but the real tragic thing for me, Anthony, is the fact that I look at all this supply chain data. I look at all these input prices throughout, agriculture, throughout energy, throughout, manufacturing, transportation, you name it. And you have all of these different price inputs that had basically stopped going up in price come February and looked like they were poised to start going down, which
Yeah.
means that as those lower input prices work their way through the supply chain, by the time you get to the autumn, maybe the winter, you're actually looking at lower consumer prices. So not just that inflation stops, but inflation actually goes negative, and that's where you start seeing those price declines. And now, unfortunately, you're seeing all that reverse. And now it's probably several years before we get back to there. Because again, the supply shock has to end, and then the demand shock has to work its way through the system. So, unfortunately, this is all higher inflationary pressures. You're seeing this both at the consumer level, but then also, when you look at things like data from the conference board, data from the Federal Reserve, but then also when and also the University of Michigan Consumer Sentiment Survey, although that's skewed very heavily Democrats, you got to take it with a grain of salt. But we're also seeing it when you look at data from the Federal Reserve Bank of Cleveland or Federal Reserve Bank of Atlanta, where they specifically look at not just consumers, but what are strictly businesses anticipating in terms of inflation. Both of those metrics have risen pretty darn rapidly. And the 10-year break even rate, the 10-year average inflation rate is now up to 2.5%, which is the highest it's been since, I believe, October 2007. And that, I think, explains part of something you've been all over, which is the bond yields, how quickly they've gone up lately.
Yeah, absolutely. So we have coming through this morning. Later today, we have UMich sentiment, and then we have UMich 1 year and 5 to 10 year inflation expectations. So we'll see what those numbers look like. Currently, the way it stands, and drill baby drill had everything to do with inflation. So while you have to say the policies in place were helping, a lot of it, to your point, just to reiterate, a lot of it had to do with the fact that energy was coming down. And that was the goal and the policy. And now we have the exact opposite because of the war. I'm not questioning, whether or not Iran needed to be dealt with. They did. And we've had, decades of U.S. presidents saying that they could not have a nuclear weapon and they needed to be dealt with. But no one really had the gall to do it except President Trump, but now he's got to deal with the cleanup after. It seems very heavy to me. It seems like there's a lot that the market is not taking in. The market can stay irrational for a very long time, for years. but it seems like the market's not really considering what the market is reacting. Let me put it this way: the market is reacting very bullishly to any headline that suggests that this thing is done, the agreement's in place, and we're not going to start fighting again, and that's fine. I'm wondering if the market is, when the market discounts the actual effects and how long it's going to take to clear those effects and that cleanup because of what's already occurred. And that seems like that is a very much, to say that's an afterthought is an understatement at this point. It's not even a thought. If we slide back for a second and we look at the inflation numbers where they are now, the trajectory now, and Warsh coming into office now, two scenarios. First scenario is if there is no escalation, what do you see happening as far as the reopening? And then where does that put the Fed as far as rates and balance sheet? Two, if there is an escalation, where do you see that putting the Fed as far as rates and balance sheet?
Well, let's take the second one first. I mean, if there is escalation, we have conflicting reports here on whether or not Iran is actually basically how quickly is Iran rebuilding their military capabilities here, because they're not having to do what we do, where we are building these multi-million-dollar interceptor missiles, right? They're building very cheap rockets. They're building very cheap drones. This is totally asymmetric warfare. Sadly, this is the lesson that we learned with the war in the Ukraine, where drone warfare, a drone that's a couple $1,000s is taking out a tank that is hundreds of thousands or millions of dollars, right? Again, completely asymmetric warfare. It's a lot easier for Iran to rebuild and restock, seems to be what we're learning. So again, we're getting conflicting reports on, during this whole ceasefire, what do Iran's capabilities now actually look like? We weren't entirely sure going into the war, and we're still, I think, a bit unsure now. So when you see that re-escalation, the reason I bring all that up is because it's not just a matter of us hitting Iran hard again. It's a matter of what can Iran do to all of its neighbors in the Gulf and damaging things like energy, energy infrastructure, wells, etc. So
Desalination plants.
exactly. And there's a report out. Again, we're recording this Friday morning, but there's a report out just this morning that the UAE and Saudi Arabia now apparently are both pressuring the Trump administration not to escalate because they are afraid of what Iran is going to do to them.
Yeah.
Iran's basically trying to hold everybody hostage. So when we talk about a re-escalation, it's not just what are we going to do, but probably more importantly, as far as oil markets go, what is Iran going to do? And that's where I think you'll start to see not so much spot prices change, because the dynamic of how much oil there is right now to get into refineries today, that doesn't change. But looking at those longer term future contracts, I think that's where you'll probably see the increase in oil prices, because then people are anticipating that the problems are going to be with us longer.
Yeah.
And that is going to have, I think, more of an impact on inflation expectations. What oil does today, yes, that has a bit of an impact, but much more so, I think, what oil is going to be end of calendar year is going to have probably a bigger impact in terms of what people think inflation is going to be 12 months out, which is what a lot of these inflation expectation readings are.
Yeah.
That obviously makes Warsh's job harder, because he's going to have to defend why inflation is going up, particularly why is inflation going up when the Fed is seemingly not doing anything about it. And so regardless of whether oil goes up or not, I actually think the Fed's course of action should largely be the same, because the Fed really shouldn't be looking much at oil prices, since it's a non-monetary input to the question of what are prices doing today. The Fed's tools are entirely monetary. You know this, Anthony. I'm preaching to the choir here, right? What can the Fed do? They can affect money supply. They can affect money velocity to a certain extent. They can't actually affect what the price of oil is. So their job is to deal with the quantity of money in the economy, not the cost of individual inputs in the economy. And I understand that the impact, not the cause, but the impact of oil going up in price is very similar to the Fed increasing the money supply, because both end up causing the price of just about everything to go up. because energy is an input in just about everything. The difference is that if you just dump a bunch of cash into the economy, you do the cash cannons that the Fed did in 2020 and 2021, to a lesser extent 2022, you now are going to cause the price of everything to go up and consumers to continue spending like they were before. Whereas if energy prices start going up, people actually end up buying less because there's the same amount of money with which to buy things that are now more expensive.
Yeah.
So again, it feels the same from the consumer standpoint because the price of everything is going up, but you don't want the Fed to make the same mistake they did several decades ago, where in the face of an oil shock, they decided, hey, we need to combat these higher prices with higher interest rates to try to bring prices down, and it just made everything worse. So this is where the Fed needs to look past oil prices and look at what is the quantity of money doing, what is the supply of money, what is the demand for money. Those are the things on which they need to base their decisions.
And what do you think? What decision do you think that leads them to? It sounds like you're saying rates should not go up. It sounds like you're saying, if I'm reading into it, that rates should be steady to potentially slightly lower, and the balance sheet should shrink to some degree. Is that where you're at? Or what do you think, if you were Warsh and you were stepping in, what would be your base case right now?
I think the base case right now is going to have to be just unwinding basically the whole dynamic we have in treasury markets today, which is banks are essentially getting interest from the Fed,
Yeah.
and then they're turning around and taking the money they get from the Fed and buying treasuries with it. Now, it's a little messier than that, but that's the very quick and dirty version of it. The Fed is still subsidizing the treasury market. Look, as long as the Fed has, is keeping its own interest rates below the yield on treasuries, that's a pretty easy arbitrage, right?
Yeah.
And so again, you're going to have to unwind that, and it's going to be, I think, a bit of a painful process because it will involve shrinking the balance sheet. It will involve probably higher treasury yields in not just the short term, but in the long term.
Yeah.
But that is going to put a tremendous amount of downward pressure on inflation, and I think that's going to be Warsh's strategy going forward. It's not a matter of we need to slam the brakes on the economy with these higher interest rates, but rather, again, getting us back to kind of a pre-GFC monetary policy.
Okay. Okay. This is going to be interesting. I think this was, as always, really helpful, insightful. I think, I'm really focused on Warsh, how he comes in, how the market reacts. We have the end of what is I guess, a negotiation, which has become essentially a stalemate. And, I hate to say, but at the moment, I feel like Iran is creating much more noise than should be allowed to, or we would like them to, particularly in the Strait and in the region. Um, and I think that we're kind of at the spot where President Trump and the administration, Department of War, really need to think about what the next steps are there. I know we have this financial stranglehold on Iran, and I'm fine with that. But I think to some degree, what I'm looking at is Warsh and the Fed. I'm obviously looking at technicals in the model as far as trading. And I think that the Iranian situation is different than was expected. I don't think that we're not prepared to handle it. I want to be really clear. And I think we will, as we always do. American exceptionalism is a real thing, alive and well. But I do think that the Iranians are playing a different game than we expected them to play. And I think that we need to adjust. It's about time that we adjust the game plan. I don't think the financial choking out is working. And the reason I say that is it's taking too long now, and it's hurting really too many nations, including the U.S. and the global economy. Iran, I'll give them some credit in the game they're playing, but it's time to kind of weed out the rats and get this thing done and wrapped up as best as possible. And by the way, get what we want from the deal, which is the uranium, to make sure that they don't have a nuclear weapon and to stop them terrorizing the region and the globe. So I think that we are probably at an inflection point with the market. We've had some big IPOs. We've had some large events. We have Warsh coming in. We're not getting where we need to get on some of the other items. And Iran is obviously a big one. You can see in the way the market reacts on a simple headline. The fear that I have is when there's actually an event or a resolution or event, upside downside is going to be more significant to the downside than to the upside. I think we've priced in all the good stuff and the peace treaty being signed, the agreement being signed, and this officially stopping and the strait opening up. We've continued to kick the can down the road, but we haven't stopped buying the market. Structural or not, markets at all-time highs, period, end of sentence. So I think the potential surprise or market shock from the Middle East is to the downside. I think gold is telling you that, the dollar is telling you that, crude is telling you that, rates are telling you that. The only people that haven't kind of noticed that there's a party going on is the equities market, which is typical. The equities market will come in. They'll come in last and get the last pig in a blanket and a little sip of juice, and the party's over. So I think that's kind of where we are. Insight's incredible. This was actually a really great episode. And one final point I would say to the listeners, if you want to look up and see exactly how our strategic petroleum reserves operate, you mentioned the water levels and the rising and the lowering of the crude. The fact that they're in natural salt vaults, from my terminology, and the way we have created them and the way they function is fascinating. So anyone that wants to look that up, that's a really great point. This has been another great episode, EJ. I really appreciate the insight. At Real EJ Antoni on X. I'm there all the time. I encourage everyone to check it out. I am at CMT_Anthony on X, or you can go to Ascalon6capital.com to check out the website. EJ, thank you so much. I really appreciate it. Friday morning here, heading into the weekend. Have a great weekend. We'll see what the inflation expectation numbers look like. We'll see how we finish the day, and we'll see what the weekend brings, my friend. Happy Memorial Day, by the way.
Same to you, my man. Always a pleasure. Till next time.